QuickBooks Pro Plus Desktop 2022 OneNote presentation. Receive payment form. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Topic Introductions tab, down in the 1360 Receive Payment Form tab. Also note, when using OneNote, take a look at the Immersive Reader tool, Topic Introductions, also in the text files, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Also note that the same name and number of the topic introductions will be found on the presentation's topic introductions, designed to give an introduction to the topic, provide screenshots and links when necessary, as well as an overview of the accounting topic to supplement the information we'll be doing in QuickBooks presentations. Closing the icon on the left-hand side, we're looking at the Receive Payment Form. First screenshot being the home page. If you're following along with the presentations, don't have access or don't want to open the QuickBooks file, you can use the screenshots to help follow along with them. We've been focusing in the customer section on the home page, looking at the flow last time, looking at the form of the invoice increase in accounts receivable, other side then going to sales, and then you might have the inventory involved. But the main point for us here is the accounts receivable increase, because now we're moving to the receive payment form. That means receiving the payment for an invoice done in the past. That accounts receivable is going to go down. The other side either goes directly into the checking account or it goes into undeposited funds. That's where kind of the tricky component happens at this point in time. And the reason that's a tricky component is, one, we don't see it on the accounting side oftentimes when you're learning accounting, because you just see cash as cash instead of posting to a checking account versus us holding on to the cash. And so you don't see that undeposited funds. And two, because it'll differ as to how you want to record it depending on the structure of the flow of your receipts. If you're getting the flow of receipts and you plan on then putting them into the bank in the same format as you receive them so that our books will match what's on the bank statement, then it might be good just depositing them directly into the checking account. If, however, we're going to receive multiple receipts, possibly from cash or from credit card payments, that we need to group together in some way in order to match what will be seen on the bank account, because we're going to group those cash receipts, then go to the bank at the end of the day, depositing multiple receipts at one time. Then we want to take it through the clearing account of undeposited funds, then deposit it in the same grouping that we hope to be seen on the checking account, so that we can tick and tie them off as we do the bank reconciliation or when using the bank feeds. The customer payment form looks like this. This is generally a more internal document. If we choose the customer, it will typically link to an invoice. Selecting the invoice will then tick and tie out the transaction. By default, it will be going to undeposited funds. In other words, transaction being decreased to the accounts receivable, other side going to undeposited funds. If we want to then go to the checking account, we can then go to the preferences, edit drop-down, preferences, payments on the left-hand side, company preferences up top. This checkbox right here is to use undeposited funds as the default. If we uncheck it, then go back to our customer payment, we then have this item down below so that we can choose another account other than the undeposited funds, possibly being the checking account, making a deposit at the point in time we receive the payment. Then if we look at the balance sheet, the accounts that would be affected, the accounts receivable would be decreasing because they're getting paid off. The other side not going into the checking account, but undeposited funds. If we're using that clearing account, it's a clearing account because it's going to go up for a very short period of time, then go back down when we take that money and deposit it into the checking account. Clearing account being different than a temporary account. Temporary accounts being, to me, accounts like the income statement accounts, income and expenses, that will roll into the equity account, closing out during the closing process at the end of the month and the end of the year. This one, clearing account, because it will clear out in much more shorter time periods, being used for a very short time just to hold the money until we're then going to transfer them over into the checking account. Also note that you would think this account should be up in the cash area. It's down here, as we discussed in prior presentations when looking at the balance sheet, because it doesn't act like a cash account in that the cash account types for QuickBooks need special characteristics like being able to be connected to the bank or financial institutions. And this account acts more like an other current asset, even though it's in essence a cash account. The transaction detail on undeposited funds would be that it's going to increase when we have, say, the invoice that is going to, the payment is going to be received, and it'll typically go down with a deposit. Now, the job cost system could complicate things a little bit as well, but that's going to be the general idea. The customer balance detail report then supplementing the information or supporting the information for the accounts receivable, breaking it out by customer instead of simply by date like the general ledger or transaction detailed report. And then you'll see that the payments then here are going to be decreasing the amount. So you should be able to kind of tick and tie off by customer a little bit more easily the increase with the invoices and then the decrease with the payments that you're going to be receiving. That should be the typical trend. And the accounts should then go up and down as we do work for them and or inventory provide them for, and then they pay us and it goes back down. So then we got the customer information. So you can also find this information with regards to open invoices. In other words, when you're trying to create the form for the payment form because you're going to receive a payment from a customer, you might go to the home page to the receive payment, then type in the customer, and that will link you to the open invoices that you could tie out to. Or you might go to the customer center here, find the customer that you have the invoice for, and then look for that invoice that is open in the transaction detail, and then use that to basically link to the payment. So you can also then go to the second tab, the transactions tab, go to the invoices tab over here, possibly searching for the open invoices or even overdue invoices. Once again, finding the invoice. Once you know what the invoice is, was charging the customer, you can use that to create and link to the received payment and then create that link automatically. That could be an easy way to populate that information. And then here again is going to be the payment form. Let's look at the journal entries related to the payment form. So this is the payment form, meaning we're imagining in the past an invoice went out, invoice increase in the accounts receivable, the other side going to sales, then we're going to receive the payment on it, this being the payment form. So if I record the original invoice, this is an invoice type of transaction which doesn't have any inventory involved in it, a service item for invoice. That would be an increase to the accounts receivable as we have seen in a prior presentation, this being the beginning trial balance, the adjustments that we're going to be entering, ending trial balance. The invoice would be a debit to accounts receivable, credit to the sales, or in other words, increase in accounts receivable, increase in sales or revenue. Accounts receivable starting out in our example at $2,000, going up by the $1,600 to $3,600. The sales or revenue starting at a credit, which is a positive for it. It's a credit balance of $200,000, going up by the $1,600 to the $201,600. Down below, we got the net income, which is revenue minus the expenses. This is not a loss, but a credit, $24,710, going up by the $1,600 to the $26,310 on the net income, noting the net income went up at this point in time when we issued the invoice, even though cash had not yet been received. That's the typical accrual basis that you need to record if you're going to be tracking the accounts receivable, given the fact that the accounts receivable is an accrual type of account. Then if you look at the GL, if you were to drill down on it, this is similar to a transaction detail report. The 2,000 went up by the 1,600 in the accounts receivable to the 3,600. The revenue went from the 200,000 up in the credit direction by the 1,600 to the 201,600. The accounts receivable also needing a subsidiary account, breaking this out not only by date but also by customer. In QuickBooks, this being similar to an other report, which would be an accounts customer balance detail or summary report. And this is actually the vendor report. Hold on. Okay, so now we have the customer report. Down below, customer 4, we're imagining is the transaction we're looking at. Then it went up from 0 by the 1,600 to 1,600. Our 4 customers, generically named customer 1, 2, 3, and 4. 600 plus 1,006 plus 4 plus 1,000, adding to 3,006 on the subsidiary ledger, or in QuickBooks, the customer detail report, that then matching what's on the general ledger or what would be on the balance sheet in essence in QuickBooks. Then we can see what would then happen if we got the received payment, the one we're focusing in on at this point. We got paid in some way, either cash or check or credit card or something like that. We're going to assume then the checking account's going to go up. Now, first off, we're going to imagine here checking account goes up, meaning we're going to deposit it directly into the checking account, not using a clearing account like undeposited funds as that go-between. The reason we might do this would be that this 1,600, for example, maybe it was some like an electronic transfer or something that's going to go directly into the bank account. I'm not going to get that, say, in cash and combine it with other types of cash payments and then go to the bank with it and deposit them in a group lump sum in some way. It's also not a credit card, which I'm going to basically group into one lump sum and deposit it in whatever way the credit card is going to be having us do, but rather put it into the bank account in that format so that it will be seen on the bank statement in that format, making the bank reconciliation easy to do. So in that case, we would increase the cash when we got it from the customer, the other side decreasing the accounts receivable. So now accounts receivable went up. Now it's going to go back down to where it was before. That's the typical kind of transaction. Cash then going up. So we moved the accounts receivable up into cash. So now the 100,000 is going up by the 1,600 to the 1,016. The two entries netting out now. Accounts receivable going up, going back down, netting back out. So we're back to where we started with accounts receivable at the 2,000. No impact on net income from the second transaction. That 1,600 is from the first transaction with the invoice, not on the received payment transaction, which is the one that we actually received the cash on because we've recorded it on the invoice typically being closer to when we actually did the work. So then if we go down, the checking account was at the 100,000. It went up by the 1,006 to the 1,01600. Accounts receivable started at 2,000. It went up by the 1,600 to 3,600. Then we got the payment. So the receivable went down with a credit of 1,600 back down to the 2,000, that 2,000 matching what is up here on the TB, the trial balance. We also then need the subsidiary ledger, breaking out the accounts receivable by who owes us the money. We said this was customer number 4, started at 0, went up by 1,006 to 1,006, down by 1,006 when we got the payment, back down to 0. We should be able to see even more easily in the customer breakout, the subsidiary ledger, similar to the transaction or the customer detailed report in QuickBooks, that these two should kind of tick and tie each other out. It should go up, then go back down. That's what accounts receivable accounts are typically going to do. If we add up the 4 customers, we got the 600, the 0, the 1,000, the 400, adding up to that 2,000, the subsidiary ledger adding up to the same balance as the general ledger. Let's do it on again. This time, that second transaction that we're going to deal with when we receive the payment, we're going to put it into undeposited funds instead of directly into the checking account. The rest will be in essence the same. So we're going to start off with the invoice again. New invoice, accounts receivable going up by the 1,400, sales going up by the 1,400. There's no impact on inventory. We're doing service items. So that means the accounts receivable going back up. It was at 2,000. Goes up by the 1,400 to the 3,400. The sales now going up. Started at the 200,000. It went up by these two transactions. The first invoice, now the second invoice, 1,006, 1,004, adding up to the 3,000, taking it up in total to the 3,600. Notice that the net income is going up when we issue the invoice, even though we haven't got the payment at that point. The accounts receivable started at the 2,000. First invoice, total receivables went up by the 1,600 to 3,600. Got a payment from that invoice, brought it down by the 1,600 back to the 2,000, back to the 2,000. Now it's going up with the second invoice to 3,500. The sales were at 200,000, went up from the first invoice by the 1,600 to the 2,016. Second invoice, 1,400 to the 203. Subledger for the accounts receivable, breaking it out not just by date, but also by who owes us the money. We're going to say customer 1 is the one for this invoice. So we billed them or invoiced them 1,400 plus the original 1,000 they already owed us. Takes it to the 2,400. Adding that to the other 3 customers, 400, 600, 0, takes us to then the 3,400 in the subsidiary ledger, similar to the customer detail report or summary report. that ties out then to the general ledger, the trial balance, accounts receivable, balance sheet, accounts receivable. So now we got the payment finally for that second invoice. This time we're going to put it into the clearing account of undeposited funds instead of directly into the checking account, because we might have multiple types of payments, possibly from credit cards or cash, that we need to then group together and think about how we're going to group them so that we deposit them into the checking account in the same format as they're going to be seen on the bank statement, making the reconciliation as easy as possible. So this time, cash is going up, but not the checking account, instead undeposited funds, which in QuickBooks is actually an other current asset, even though it's pretty much a cash account due to the fact that it doesn't act kind of like a checking account. So QuickBooks put it down in the undeposited funds, but it's a holding account, should represent cash that we're holding on to, or say credit card transactions that we're going to group together in some way and then put them into the checking account. Accounts receivable going down with a credit. So now the checking account's going up. If we post this, started at 100,000, it's going up now by that 1,400. Sorry, the checking account is not going up. The undeposited funds is going up now, not the checking account. That's the point. Undeposited funds going up by the 1,400 to 1,400, representing cash that we have on hand that once we deposit it to the bank will clear out to the checking account once that happens. The other side then going to the accounts receivable, which nets out the accounts receivable going back to zero at this point, meaning it went up with this transaction by the 1,004, then back down by the 1,004. No impact on net income from this second transaction because we've recorded it at the first transaction when we actually issued the invoice. The undeposited funds account went from zero up by 1,004 to 1,004. We would expect after we collect any more cash or whatever the payments are for the rest of the day, we would deposit it into the bank in whatever grouping we think is going to be on the bank statement and move that from undeposited funds to the checking account, which is the reason undeposited funds could be called basically a clearing account, because it should go up and down, back down to zero in a very short period of time, just being used to group the accounts together, a clearing account type of function. Then the accounts receivable started at 2,000. We went up with the invoice by 1,006 to 3,006. Then we got a payment of 1,006, bringing it down to 2,000 again. Then we invoiced again 1,400 to a different customer, bringing it up to 3,400. And then we got paid by that second customer, 1,400, bringing it back down to 2,000. We also need the subledger related to the accounts receivable. That showing that for customer one, started at 1,000 they owed us before we invoiced them. We invoiced them by the 1,400, bringing us up to the 2,400. Then they paid us for that second invoice. They never paid us that 1,000 still, so we're still going to ask them about that one, bringing us back down to that 1,000 balance. So we got the 1,000 plus the 400 plus the 600 plus the 100, adding up to that 2,000, matching the accounts receivable balance at the 2,000 for the general ledger. So then if we thought about the whole process here in terms of what QuickBooks is actually doing, then when we enter the forms for the invoices and then the receive payment forms, these in essence can be thought of the journal entries behind that. Then that is then being posted to the general ledger. And as we post it to the general ledger, if there are any subsidiary accounts that need to be impacted, such as the accounts receivable, it will know how to do that because the data input forms that are being used, which are going to be the invoice and the receive payment forms, are forcing us to use the added information needed by QuickBooks to report on those subsidiary ledgers as we do the data input. Then QuickBooks would use the general ledger to create the trial balance, ending balance. We're showing a beginning and ending balance to look at the impact directly on this list of accounts, basically the trial balance, to see the activity a little bit more clearly, I hope. And then we're going to take that trial balance and use it to create the financial statements, that being then the balance sheet, the income statement, the statement of equity. In practice within QuickBooks, most likely we would be entering the invoices, entering the receipt, then generating the financial statement reports, such as the checking account, such as the accounts receivable accounts, such as the income statement accounts, and then drilling down on those particular accounts, like the balance sheet, the reports, like the balance sheet and the income statement, then drill down on the reports, like the accounts receivable, like the cash, like the sales account. If I drill down on, say, the sales account, for example, that would take us to that form of transaction detail report, which is in essence like a general ledger type of report, giving us the items by date of transaction. If I drill down from the balance sheet to the accounts receivable account, for example, it would give us that information of the accounts receivable going up and down. Then I might say, hey, I would like to see my accounts receivable by who owes us the money, which would be a subsidiary type of ledger, subsidiary type of report in QuickBooks. That might be something like a customer balance summary, customer balance detail, or customer aging report, which is subsidiary to the general ledger, because the ending balance of all the customers should tie out the same balance on the general ledger or transaction detail report, as well as the account on the trial balance and on the balance sheet in accounts receivable.